Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? All right. So we should be live. I don't know, like I said, I don't know if there's going to be a delay or anything like that. So we'll first maybe just wait a few minutes and do a little bit of an introduction, because this is going to get recorded too, and we'll release it as a podcast. But this will give time for people to get, sort of the notifications that we are live on the other platforms, and that they can join if they want to. I don't know if we're seeing anything or not seeing anything on the other platforms at this point, but
Not yet.
we're gonna do a
No.
not yet. All right. Well, we're gonna do a live stream Q&A, hopefully, and otherwise we'll just kind of talk about some of the sort of frequently asked questions involved in multifamily real estate. For those of you who don't know, you probably do if you're listening to this via podcast or joining on my social media. I'm Jason Ballara. I'm here with Rachel McFarlane. Rachel, I'm excited, is coming on board as our investor relations coordinator. So you'll be seeing a lot more of her. This is very new, and this is your first introduction, Rachel. So thanks for being on, and we'll do more formal introductions via website and some posts and things like that about your background. Song, we've lost your camera, but I think that's just because of the...
Oh no.
Oh, there you are. The internet is probably a little bit glitchy and having trouble with three of us on, but that'll figure out. Anyway, so the plan for today is to try and just go through some of the commonly asked questions and maybe holdups or limiting beliefs that people have around investing in general and investing in multifamily. And we can talk a little bit about our fund, kind of whatever. So we'll definitely keep this under an hour for sure, and if it's less than that, then that's totally fine. Well, we are about 2.5 minutes in. Are you seeing anything, Song, on the, has it notified? I'm wondering, I guess I would have notifications on my...
I don't see anything so far.
This is our, of course, first time trying to go with this live stream on through Riverside, and it's supposed to go out to multiple platforms, hoping that it works, but this may end up just being a recorded session for the podcast, because I don't see anything. When I look at Instagram, it does not show that we are
Live.
All right. Well, maybe we just have to. We'll just chat and record, and hopefully, if anyone happens to notice that it pops up live somewhere, then we can have we'll have a better chance at doing LinkedIn. I don't see, not on LinkedIn. Luckily, someone can hopefully edit out some of this. All right. Anyway, let's just talk, and if the live thing happens, it happens.
Okay, not just round.
Yeah, exactly. It'll be we'll be able to get tech support after the fact, I guess, from Riverside, and figure out what I did wrong and why it's not working. But and maybe it just takes longer to actually start connecting to the live platforms. Like maybe it'll pop up at some point here. But anyway, so I thought it was worth starting with just kind of what is generally when I start talking to investors or anybody, about what we do, oftentimes the first question and the first topic is, what is syndication, right? Most people know what real estate is. They understand, or they've heard, or they knew someone who invested in real estate, and they know that they're, that person had an experience, good or bad. There's definitely people that have had good experiences through their own real estate investing. There's also been people that are like, at one point I owned, a 3-family, and it was terrible, and I hated managing it, and people were calling me in the middle of the night about their toilets and that kind of thing. And so there's different and varying, I guess, experiences within real estate. But a lot of people think that when they are considering or talking to someone about investing in real estate, that means you buy a single family or a duplex or something like that, and then you own it, manage it, and kind of do everything yourself, which is an option for sure. But what we do from a real estate investment perspective is something called syndication. Syndication, I think the easiest way for me, I describe it as a way for people to partner together, pool their resources, and purchase assets, larger assets, more expensive assets than one person alone typically would be able to do. Unless you're multimillionaire, billionaire, that you could possibly do it on your own, but it's not always the best use of resources to try and buy those large assets on your own. And so what most people don't know is most of the commercial real estate, apartment buildings, office buildings, storage spaces, most warehouses, things like that, most of that stuff is transacted or bought and sold through syndication. So it's not owned by one single person and then sold to one single other person. It's sold to a company that owns the asset, and that asset is usually oftentimes a syndication. And so within the syndication itself, there's kind of two sides of the coin. There are the active partners, and then there are the passive partners. They go by different names, but the passive partners are sometimes called limited partners. They're the investors, and I don't personally like the term limited partner because I feel like that maybe implies that they're not important, but they're incredibly important to the deal because generally those investors are bringing in most of the capital. They're the limited term, just so people know, really goes to speak towards their liability. As a limited partner, you have no legal liability, you have no responsibility for management, maintenance, anything, any of these active portions of real estate. You have no participation or obligation as a limited partner. But again, very, very important to the deal itself. On the active side of that equation, there are the active partners, or sometimes they're referred to as general partners or sponsors. And those are the people that do all of that management stuff. They find the deal, they purchase, they assemble investors, they find the financing for it, and then they manage the deal after the purchase has happened. So a lot of the stuff that gets talked about out there is often the transaction side of it, like what happens before you buy the asset. But equally, if not more important, is what happens over the next 3 to 7 to 10 years while the asset is held and how that gets managed. So that's where the returns come from. You make your money by buying a good deal, but you also make your money by managing it well. So those are the components of a syndication. Once that deal closes, you have, again, those managing partners are doing sort of all of the work. They're updating the investors, keeping them informed on what's going on. The investors should be receiving, generally it's monthly at least, updates as far as how their asset is performing, and they are participating in basically all of the same benefits as the active partners. With that, you're getting participation in whatever cash flow is available from the asset, participation in the tax benefits from that asset. We can talk a little bit about those things maybe, but on general terms, you're talking about cash flow, you're talking about tax benefits, and then you're talking about appreciation and participating in the proceeds from the sale when that asset eventually gets sold. So that's in a nutshell kind of the pieces of the puzzle, and how it is all structured. There's obviously a lot more that goes into it in terms of the actual process, but I figured I might pause there and see if either of you wanted to add anything or throw out any questions that you've heard from people or have yourself, just on that component, and then we can go from there.
Yeah, so you answered most of the questions that I've encountered, but one that I recently got is, how many units make something considered multifamily? Is it 4? Is it 50? I guess people are asking kind of like, is a duplex considered multifamily? Is a triplex?
Yeah, that's actually a great question, and it depends on who's doing the considering. So from a lending standpoint, the cutoff is basically 5 units. So you have 5 units. Above 5 units is considered commercial real estate. So below that, you're talking about, it's still multifamily even at a duplex, but it's residential multifamily, and most commonly that particular question is a lending question, because, for example, suppose you did want to, you're like, I'm going to do it on my own. I want to buy, I'm going to go out and buy a bunch of single family or duplexes or whatever the case may be. Some of that depends on where you live too, right? Like in where I grew up in Boston, at least when I was there, most of the multifamily was 3 families. That's how Boston is kind of built. It's 3 family vertical stacked units. There was almost none of the sort of large scale multifamily complexes that we're talking about when we were purchasing with our buy box, but it's still multifamily. At one point I owned a 3 family in Boston. So, but from a lending standpoint, when you buy those, you're going to be buying generally as yourself, right? You're going to be purchasing under your own name. Maybe you have a family trust, something like that, but generally it's going to be in your own name. And the rule of thumb is I think people say the first 4 that you buy under your own name, pretty easy, pretty standard. You're going to have the same lending type of principles that you would have for purchasing your own home. And you have some of those advantages, like if you're buying your own residence, even if it's a multifamily, you might be able to qualify for an FHA loan, which gives you the ability to have a much lower down payment if it's owner occupied. So there are ways to do it that can be advantageous, but ultimately, I have been told the first 4 fairly easy to get the loans based on that, and then it starts to get harder and harder. And typically, most traditional lenders will not lend to you once you get to 10. Right, so if people are trying to scale and they get to 10, whether that's single family, duplex, triplex, some of these residential multifamily, you're going to start to reach a point where people won't lend to you anymore, because they'll look at it as kind of being overextended. At that point, and these are generalizations, like oftentimes there are ways around this. You can find seller financing, like there are other creative things to do, but generally you're going to have a limit to the number of bank loans in your own name that you can have. And also, those loans are typically what we call recourse, so they would be taking into account your own, your own income. They're gonna potentially be taking your own home or not taking it, but using your own home as or business as collateral, exactly, like something that would be kind of on the hook if you defaulted. When we get into the larger commercial multifamily, And again, it still does break down into size. So they actually have what they call like small commercial lending versus, especially if you look at agency loans, which is government-backed loans, they have small commercial lending versus large balance commercial lending. And in fact, the bigger the loan is, the bigger the asset is, like from a monetary standpoint, the banks, as well as us as sponsors, consider that safer. And so you can actually get typically a better rate, better terms, and higher leverage on a larger asset than you would on a smaller asset. Because again, economies of scale, the banks, who quite frankly, the bank is going to be your single biggest investor in whatever deal you're doing, because they're going to cover 60 to 75% of that purchase price. So those banks like the economy of scale. So if you're purchasing, it sounds crazy, but like if you're purchasing a $70 million apartment complex versus a $7 million complex, you're going to have far more favorable terms on that $70 million complex than you would on the smaller one, which I think to a lot of people is probably counterintuitive. It was to me. I thought, sort of excuse me, smaller was safer, but it makes sense now that I know how these operate. It's like not only do you have economies of scale, you have the larger the asset, you have a larger safety margin in terms of, if we just look at, say, vacancy, right? So if you own a duplex and one person moves out, you're at 50% vacancy, right? Yeah. But if you own a 400 unit apartment complex, you have to have 200 people move out to get to a 50% occupancy, and that just doesn't happen, right? So like you could have 20 people move out and you're still at a very reasonable occupancy number for those larger complexes, and it's not gonna hurt you tremendously from a revenue standpoint. So I think that's kind of a long-winded answer, I guess, to that, but most of the time that question gets answered by the lender. And so typically that cutoff is 5 units. And I guess that goes into, what our buy box is currently, and we're looking for greater than 100 units because, again, the higher we go in unit count, the better the better we can optimize economies of scale, staffing, things like that. Like if you have, again, and this is from personal experience, like we have an asset that's 70 units. We also have an asset that is 90 units. Even that difference in 20 units makes a tremendous difference in terms of how effective the revenue management can be, because so if you had exactly the same amount of vacancy in terms of absolute number, like if you have 10 vacancies, well, your actual vacancy percentage is much higher on that 70 unit than it is on the 90 unit. And you have, oftentimes it comes down to like staffing, right? So typically somewhere at some point in size, you're going to have one on-site manager and you're going to have one maintenance person. And that typically works right around 100 units. Smaller than that, you still kind of need to have someone on site, so you have to pay them, but you're on a per unit basis, you're actually paying a higher salary, right? So if that makes sense. So the economies of scale are very, very real, and that's just talking about sort of on-site operations. But if you look at from a renovation perspective, right? So if you're renovating, if you have a duplex and you're renovating those units, you're probably going to go to Home Depot and you're going to buy stuff off the shelf and you're going to go in and do kind of one unit at a time. If have a 400 unit complex, we're probably renovating 20 or 30 units a month, and you're buying things in bulk directly from supplier, and that's going to save tens of thousands of dollars on your material cost alone. Not to mention your contractors are going to be very happy with volume versus, say, like
Consistent
coming in, I'm
work.
going to do one unit. It's not worth it for them to charge less to come in and renovate one unit for you. Then they're basically the same as like a custom home builder. So you have in the construction world, which and I've been in construction since I was a teenager, and it's a very different strategy in multifamily versus, like people that are renovating single family homes and custom home builders. Now you're building, as a custom home builder, you're building someone's dream house. Like budget matters, but people are like, yeah, I really like that tile that costs $30 a square foot. Like, and they do it because that they're like, this is my house, I'm going to live there. When we're talking about renovating multifamily, it is very much about kind of standardizing it to appeal to the largest number of people and maximizing or I guess minimizing the costs associated with that. So it's like, yeah, if we're putting tile, it's going to likely be subway tile or something. Just the flooring, again, if you can buy 10,000 square foot of flooring versus 1,000 square foot of flooring, it's going to cost you way less on a per square foot basis. You can also you can have the ability to negotiate pricing with vendors based on volume. So it's like, hey, I'm going to use this particular floor installation company for all of my properties, and if I have if I'm someone who has thousands of units, I can tell you the pricing on that flooring install is way lower than someone that's trying to renovate, their duplex or something like that. So again, long-winded answer, but that's kind of the reason why scale matters. And it's when I Song knew this because I talked to her about it, but like when I first decided back in 2020 that I wanted to do real estate more than just as kind of like on my own houses, on a very small scale, the first thing I looked at was actually residential rentals. And I looked at Atlanta because I liked the market. That's where we ended up focusing our multifamily investing as well. But I started thinking about it, and it was like, okay, so how long and how much work will it take me to find, purchase, and manage 100 single family houses, or even 50 duplexes, right? Like that could take years, but how long does it take me to go buy 100 apartment units? Like a couple months. So it's just and for that 100 unit apartment complex, I can have an on-site manager, and I don't have to be the one that's like, oh, Mrs. Smith called and said her toilet's clogged, or this, we have a leak here, or whatever. Like it's a business now. It's no longer just kind of a hobby, sort of real estate investing hobby. It's a true business, and that's how these large assets get purchased. The syndication is a company that we form an LLC for each property that owns that property. And so it is truly, you're buying a business. Each asset is a business. So it's able to be treated that way because you have scale.
Yeah.
That
Questions,
answer,
Rachel? If
that
not,
answer
I
the
have
question
one
super
other
long way.
that I've had people ask me. Yeah, no,
Yeah.
I've had people ask about, number one, how long is your money tied up in the investment? As long as you're willing to pay, fees and taxes, you can go and cash out on your stocks, right, and your bonds. So how long is your money tied up here? Is it liquid? Are you able to pull it out as you need it?
Yeah, no, it's a great question, and honestly, it tends to be one of the objections that I hear about is the illiquidity of real estate, but I actually think it's probably a good thing. But also, I think that you have to kind of reframe how you look at that. So, a couple of the answer to the question, the specific answer to the question is the typical hold time is generally around 5 years. Like that's typically the hold time. It might be 3 years, it might be 5 years. Some deals it's going to be 10 years for different reasons. And so you have to look to answer that specific question, you have to look at whatever offering summary you've been presented for the deal. Like specifically for our fund, we're looking at a 5 to 7 year hold time. That's kind of the projection on our fund. But yeah, some people, if you're doing like for example a development deal, typically those are going to be maybe 2 or 3 years, because if the business plan is to build and then lease up and sell, which is a common business plan, that takes 2 to 3 years. And so those investors in those deals typically are going to get virtually no cash flow through the life hold for the hold of the deal, but then they're going to make a big return when it sells. And so in tangent to your question about like the hold time, you have to decide what do you want your hold time to be. You could go out and be a private money lender to house flippers, and the hold time the money is going to be tied up for 6 to 12 months, and that's a much shorter hold time. But the reason why I see the illiquidity of real estate as a good thing is because you don't actually lose any money until you sell, right? So if we hit a market downturn, which we did, if we don't sell, we don't lose any money. On paper, sure, the valuations have gone down recently, but the thing is, that's generally tied into the interest rates. So the projections now are interest rates are going to come back down over the next year to 18 months, if not more. And so the valuations are going to come back up, because a lot of this, as I mentioned before, your largest investor is the lender. So if the lender is putting up 75% at 3% interest rate, which is what was happening 2 years ago, versus 7 or 8% interest rate, which is what's happening right now, that changes what you can purchase that asset for, because you've got to pay that lender through the hold time, right? So a lot of the changes in values right now have been related to interest rates. But if you don't have to sell, and then the interest rates come back down, nothing. So being illiquid isn't necessarily a bad thing. The other thing that I think is kind of ironic about people objecting to that is, so traditionally, so many people, their retirement plan is 401k and IRAs, right? Like that's the thing that people know about, and they do it because they're told that they should do that. Well, you can't touch that until you're in your 60s. So that's pretty illiquid as well, and people do it without a second thought. So it's kind of ironic to me that people will do that, but then don't like a 5-year hold time on a real estate investment. The other, I guess, twist on that is you can use a self-directed IRA and invest in real estate. And so now your sort of illiquid concerns are completely gone, because it was already an illiquid account that you had, and now you're just putting it into real estate so you can diversify from. I don't think people shouldn't invest in stocks. That's fine. I don't I invest in stocks, but there's differences and reasons why you might want to consider both. But the hold time is based on the specific deal, right? So there's, like I said, there's those development deals. The flip side of it is, like, for example, a really hot thing a couple of years back was opportunity zones. Opportunity zones were, I guess, underdeveloped portions of the country. There's a map. You can look it up. There's a map that's like, here are all the opportunity zones that were defined by the government. And if you invested in a opportunity zone deal, you could actually sell off stocks or some other asset and take that money and roll it into an opportunity zone deal, and you wouldn't pay any capital gains on those other asset sales until 2026. Also, the basis for that capital gains tax was decreased, I believe it was by 10%, and that might have been a scaling thing. I don't know. I know by the time I got into one it was 10%, but it might have been even more if you had gotten into the opportunity zone deals earlier. And so those taxes are deferred. So I did this. I sold off a bunch of stock, invested in an opportunity zone deal. In 2026, I'll have to pay the taxes, but at a reduced rate based on what I made off those stocks. Okay? So, but the really great thing about opportunity zones is that they have, if you hold them for 10 years, there is no capital gains tax at sale of that asset, right? So imagine we're talking about assets that are tens of millions of dollars, and so think about the capital gains tax on that sale is millions of dollars. So when that sells after 10 years and that capital gains tax is gone, that's millions of extra dollars that are going to the investors in those deals. So the government incentivized people to develop these portions of the country for exactly this reason. And this is why real estate investors get favorable tax treatment, is because there's government incentives to provide housing and jobs and develop areas that are kind of underserved. So the hold time is going to depend on the deal. That's very much, and you have to, it's true, like it's in a liquid asset. There are actually kind of loopholes that you can get out of these deals if you absolutely have to, but it's a lot like if you pulled your money out of a 401k or IRA, you're going to probably lose money. So it's there are ways to do it, but it's not encouraged. The other, I guess that kind of segues into another good thing to bring up, is that all syndications are governed by the SEC. So there are very, very strict regulations about how these things have to be handled. Anyone who invests in a syndication will you better make sure that sponsor gives you what's called a PPM, or private placement memorandum. The PPM is a really, really long legal document, and it's very scary because it's literally just, these are the risks of investing over and over and over again. Like, it'll say the same risks 4 or 5 times in the thing. And so if you've never seen one before, it's daunting the first time. The first time I saw one, I was like, what is this? Like, it's just so long too. Nobody wants to read a 70 or 90 page document. Once you get familiar with them, you realize that it's just the same stuff over and over again, and it's probably about 4 pages worth of reading. But again, like, these are things that if you're investing in a deal, especially as a first-time sponsor, a first-time investor, you should, if you have concerns, you should be able to go to that person who's the deal sponsor, that general partner, and say, hey, can you walk through this with me? Can you walk through some of the portions of this PPM? I have done that with investors. I recorded it. We spent like 2 hours, and I literally went through the whole thing, because it's daunting. And if you don't have a legal background, it's written by SEC attorneys.
It's written in legalese.
Yes, it is very comprehensive. It'll have, all of the deal metrics and stuff. It'll have it broken down into legalese, where usually you'll get, if you're thinking about investing in a deal, you're going to get an offering memorandum, which breaks that all out much more simply. But then the attorneys take that offering memorandum and make it, 3 times as long by adding legalese to it. So it's daunting, but it is it's a good thing, because the penalties for not being compliant are at minimum a fine to the sponsor. Also, you can go to jail, and I have no intention of going to jail, so I'm doing these things are going to go exactly right. Like there's no point taking these chances. Like the whole point of this, from my perspective, is family. So if I have to go to jail because it's going to take me away from my family. So I don't mess around with that. We have an SEC attorney. I know a number of them because they've been on the podcast, so it's like very easy to find out the answers to the questions and be in compliance. Yeah. So again, a bit of a long-winded answer, but I feel like those things are worth mentioning, especially for anyone who's kind of looking at this to be a FAQ for their their first deal, or what they might need to know. What else? Anything else that
Along those lines? Yeah. With the SEC, what are some of the first few questions you would, if you're a new investor, you would want to ask the person managing or the active investor? What would you want to ask them in order to make sure that they're maybe following rules and regulations to the best of their ability?
Yeah, I think it's you can ask them who their SEC attorney is, so that you could actually do a search and find that they're actually a true SEC attorney, that they've done this before. You can ask to see a copy of the PPM, so they can see that it's all written out. All of the within the PPM, typically, at least in ours, it actually kind of talks about the structure of some of the laws associated with it. I think it's you also want to ask them, have they ever had any issues, I guess judgments against anything that would have come up in actually having to deal with this, like directly have some sort of communication with the SEC. I think it's something that fortunately, sponsors don't want to go to jail. It's not, nobody's looking to do that. And so I think that tends to be, as long as someone is giving you a PPM and being, kind of upfront that these are the things that need to happen for you to be able to be an investor in the deal, I think that's a pretty good indicator. The other thing, so here's the one that probably gets a little bit slippery for people sometimes, is the accredited versus the non-accredited investors. And that's probably the biggest rule that people get hung up on or get in trouble for when it comes to the SEC and these investments. So there's multiple different avenues that a syndication can be formed, but most of the time, most commonly, it's going to be Regulation D, 506B, or 506C. There are others. There's Regulation CF, which is crowdfunding. So like if you go online and you are looking at, I forget some of the websites, but there are some websites where you can invest in real estate, and they're like, get involved in real estate, for only $1,000 or whatever it is. Like you can invest in real estate the same way you invest in stocks, and it'll be online. I have opinions about those, but that's an entirely different discussion. There's another one. There's Regulation A, which is you can go through a pretty intense legal process to make it so that your company can put out offerings to anybody, whether they're accredited or not accredited, because you've sort of done the work ahead of time to have your company as a whole be within that Regulation A criteria. But it costs like hundreds of thousands of dollars to do it, and it takes like 6 to 12 months. And so most people don't do that unless they're like a huge syndication company. The example that comes to mind is Grant Cardone. Like he's a big name. People know him. He does a lot of marketing. He's done a ton of real estate, and I believe that all of their deals are Regulation A. So literally anyone can invest in them, unaccredited or accredited, because they've done all of that stuff kind of ahead of time. But most commonly, the syndications are going to either be 506B or 506C. The main differences here are 506B, you can have accredited investors and up to 35 non-accredited investors in those deals. Just for quick definitions, accredited, and there are more things that qualify as accredited, but the main definitions that get used are salary-based and net worth-based. So if you make $200,000 a year as a single person, or $300,000 a year as a married couple, then you would qualify as accredited based on salary, or if you have a net worth of $1 million, not including your primary residence. So those are kind of the two main, and they're actually, I believe, looking at upping those numbers potentially, especially the net worth thing. I'm not sure exactly where they are in that process, but as I know, this date, that's where the being accredited most commonly falls. It also, like, you're accredited if you work for a company that does what we do. Like, there's other little loopholes. You can also get certifications and licenses to sell securities, and if you go through those processes and take those tests, you're accredited. My understanding is there may eventually also be a test that someone could take just as like a regular person to qualify themselves as accredited. That's been discussed as well. But again, most commonly,
and the point
as
is
of now,
to
is that salary.
prove that you. I'm sorry. I said, and the point of that is just to prove that you're knowledgeable and you understand what you're getting yourself into.
Yeah, it's to prove that you understand that there are risks involved in investing. As an aside, I hate these rules because you can invest in the stock market. Anyone can invest in the stock market in any stock they want and can lose all their money without being accredited. You can you can go right now on your phone, get a Robinhood app, upload the money. It takes a few days for it to clear, but upload whatever money you want, put it on whatever stock you want, and you might lose it all. And anyone can do that. There's no rule about, because with these publicly traded companies, that you have to be accredited to invest in them. So I think it's a miss in terms of the fact that people are limited from being able to invest in real estate. I think it doesn't make any sense. People lose money. You can put your money on cryptocurrency, and lose. Like, you can also make money, sure, but it's no less. It's no more safe to invest in stocks or Bitcoin or whatever than it is to invest in real estate. And frankly, I think it's the opposite. I think it's safer to invest in real estate. And maybe that's because some of these regulations exist. I don't know. But the reality is that it does limit people. And so if you are accredited, you can invest in just about anything. You'll have access to the deals. Like I said, 506B, you can have accredited investors, and you can have up to 35 non-accredited investors within the deal. I guess downside to the 506B is you can't publicly advertise. You can't market it. So everyone who invests in that, you, as the deal sponsor, you have to already have a pre-existing relationship. You also have to have a pre-existing relationship as the investor. And so this is probably the place where people get in trouble, because they're trying to raise capital for a deal. They get introduced to someone and they're like, yeah, sure, come into this, someone who's not accredited, they get introduced to them. And actually it doesn't matter. In a 506B, they can be accredited. If you don't know them, they can't invest.
You still need that relationship.
Yes, you still need the relationship even if they're accredited in a 506B. So you have to be very, very careful. That's generally where people get in trouble is they sort of accidentally market a 506B deal, or they bring someone in who, friend of a friend, but technically it doesn't meet that qualification. So those are the biggest probably issues in compliance. 506C is great because you can market it. Anybody can come in. Like, so I could have, someone could go to our website today that we've never met and say, you know what, I love the idea behind this fund. Sign up and invest. Anyone can do it but they have to be accredited. So we can't take any non-accredited investors in our fund, which is unfortunate because I have friends who are not accredited that would like to be a part of the fund, and I can't bring them in. And that would be, again, another area where you could get into trouble with compliance, if you said, this is my friend, nothing's ever going to happen, I'm going to let them invest in this deal. And if it's a 506c and they're not accredited. So it's just sticking to those rules, and they're pretty clearly defined, and you can talk to an SEC attorney that'll tell you, like, this is how it goes, like, and so it's not really hard to follow those rules. Does that answer the question? Do you have follow up to that, Rachel?
No, but no, it answers the question. I actually appreciate how much you elaborate and continue to answer the question in very detailed ways, because yeah. And then another question I have is, what about interactions with an active investor? As a passive investor, how much, other than reporting, how much interaction should I expect to have with my active investor or manager?
As much as you want, honestly. That's my perspective on it. Like, you're going to get your monthly reporting, and this is it's a great question, because I think it's one of the big upsides if we're comparing, again, going back to that, like, stock market comparison. If you're investing in publicly traded companies, I always use Apple as the example, or Tesla, whatever. Like, so if you invest in Tesla, like, how many times are you going to get on the phone with Elon Musk? 0. Like, you're not going to get anywhere close to Elon Musk. I think Tesla's a great company. I did no problem investing them, but I'll never talk to Elon Musk about how things are going at Tesla.
Yeah.
And so with these private placement memorandums, you should have the phone number, the email, direct contact to whoever that sponsor is, and, like, frankly, their team. Like, this is exactly why we're bringing you on, in large part, is like, that way we can make the investor experience even better, right? So if they can always reach any of us and ask, questions at, where do we stand? Hey, you sent out this report. I don't understand this number, or I don't understand, like, why did this number go up from last month, or why did this number go down from last month? What does this particular metric mean? Why aren't we giving distributions right now? Why is this distribution different from last month? Like, you can have direct access to ask those questions. So I think, if you're calling your sponsor every day to ask the same questions over and over again, they might not ask you to invest in the next deal, but the reality is you have that access, and if you're not here, you're not getting communication, you're not getting those reports, that sort of thing, then you won't invest with that person the next time. And, like, the best possible thing that I think that can happen for us, like, as Lark Capital, is that every investor we bring in invests in, like, continues to invest in our future deals and tells their friends, right? Like, that's the best possible thing that can happen, because now we're creating, sort of circles of impact and opportunity, and kind of spreading that out. And so it's just I think, making things accessible. That's why we redid the website. I went through the website and I was like, this is not user friendly enough. I want people to be able to go to our website and, like, have no challenges getting to the information that they want. So it will keep refining those things and kind of building those platforms out so that we can make it easier and easier. We'll continue to do more things like this, so that we can, like, I don't know, I'm fairly certain we never went live on anything in this, and it's been an hour, so I don't know. I don't know why it didn't work, but we'll figure that out and we'll do it again. We'll keep we'll keep fixing the bugs and making things work. So again, a bit of a long-winded answer, but, like, I think really I'm realizing, like, the investor experience is probably the most important part, right? Like, that's why we're doing it. If I wanted to just do real estate alone, I could just do that. Like but this is to me a way to kind of be impactful and help other people. And I guess circling back to the accredited versus the non-accredited, our fund is a 506c, so people have to be accredited. However, it doesn't mean that we will only do 506c deals in the future. And so if people are listening to this, or if you're talking to investors and they're not accredited, it doesn't mean that they can't be a part of it. And it's almost more important to have those conversations with them so we can establish pre-existing relationships for future 506b deals, right? Because not to get too deep into the weeds of structure, but like, for example, we could go and buy an asset as I'm going to say this, and I will actually clarify this question with my SEC attorney, but we could go out and buy a deal as a 506b transaction that our fund invests in as one of the investors. And so that way we would actually have a 506b deal that we could bring non-accredited investors, and then the fund is one of the accredited investors into it, right? So there's part of the reason why the fund sort of needs to be 506c is because we need to be able to market it. Because it's open for a period of time. And so if we didn't know someone at the beginning, like when the fund opened this summer, or last summer of 2023, if we didn't know someone then, they couldn't get into the fund even if they were accredited. So and this was a discussion that I had with my SEC attorney to sort of figure out, like, does it need to be 506c? And he was like, yeah, if you're not raising for a one-time specific deal, that means that the only people that can invest in the deal would be people that I already knew. And so it wouldn't allow us to do what we want to do, which is to go out to the veterinary community and their circles and bring this opportunity to them. So it would have kind of handcuffed us from creating the impact that we want to. Makes sense?
Awesome.
Okay.
Yes.
Well, listen, I know Song has a birthday party today to go to, or to put on, or some sort of celebration. So we've been an hour. I'll have
Trampoline
to figure out why. What's that?
Oh boy.
I said a
said, oh,
trampoline
boy.
park, but it's not
Oh,
big. It's
perfect.
just our fam, 4 people.
Well, that'll be a blast. But yeah, I'll figure out why it didn't go live. We'll do this. This will be recorded as a podcast episode so people can listen to it, and we can do it again at some point in the near future once we figure out why it didn't go live. But I would just finish with thank you both for all that you do and for being on here this morning, and also for folks listening. Please check out our website. As I mentioned, it's been newly updated. I kind of love the way it's structured now. Pretty much anything you could want to know about our company is on there. There's a blog, there's links to the podcast, there's the deal room. Really, it's all right there, all the social media links and things like that. So that's larkcapital.com, and then follow us on social media at Lark Capital on Instagram, and it's just Jason Ballara on Facebook or LinkedIn. So wherever you would like to find us, it's pretty easy. And thank you guys again.
Awesome. All right. Have a good one, everyone.
Thanks, Jason.
Hey there. I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?